All right, let's jump right into this explainer. Today, we're uncovering a highly coordinated, frankly kind of hidden blueprint of banking changes that are quietly rolling out in March 2026. While everyone else is super distracted by the crazy everyday headlines, there is a massive recalibration happening right under our noses. And trust me, understanding this stuff now, it's going to put you miles ahead of the curve. Seriously, think about this for a second. Have you noticed your bank getting, stricter lately? Maybe you had a debit card randomly decline for a totally normal purchase, or a standard transfer just took way longer to clear than it used to. Look, there's no viral countdown or flashy breaking news segment about this, but behind the scenes, regulators have systematically recalibrated the entire financial system. It's not just a glitch, and it's definitely not bad luck. It is part of a much larger, highly organized shift. So, here's our roadmap for today. First, ACH and automated fraud detection. Second, capital supervision tightening. Third, real estate transparency. Fourth, digital trust and limits. Fifth, the big picture on system visibility. And finally, number 6, your action plan. Okay, kicking things off with Section 1, ACH and automated fraud detection. To truly grasp how massive this March 2026 shift is, you've got to know who's actually pulling the strings. Meet NACHA. They're the governing body for the ACH network. Basically, they manage the electronic payments we all use every single day. I'm talking your direct deposits, your payroll, Zelle transfers, basic bank-to-bank movements, the whole shebang. So when the absolute backbone of U.S. electronic payments tightens its rules, it literally affects almost every transaction you make. We're talking about completely updated, hypersensitive, risk-based fraud monitoring rules that will fundamentally change how your daily transactions are judged.
Let's put that into perspective. Imagine your normal, everyday baseline behavior is, say, around $100 in spending, and maybe 2 deposits a month. But suddenly, you show what the system considers anomalous behavior, a $900 purchase, or maybe you get 5 deposits in a single week. Well, these new automated systems, they absolutely do not care about your personal explanations. They don't care if you're just having an unusually busy month. They are strictly hunting for deviations from your past behavior.
And boom. That triggers the new freeze protocol. Step 1, the algorithm sees the deviation. Step 2, the system instantly freezes your account. Step 3, questions are asked later. I want to be super clear about this. Under this stricter monitoring, you aren't being frozen because they think you're a criminal. You're getting frozen simply because an algorithm flagged a numerical anomaly. And in 2026, the algorithm shoots first.
Moving right along to Section 2, capital supervision tightening. This all ties into some intense regulatory scrutiny that's being placed on financial institutions regarding liquidity, compliance reporting, and anti-fraud. It basically boils down to this fundamental dynamic. When regulators increase scrutiny, banks drop their risk tolerance like a bad habit. It's a chain reaction. When your bank's own compliance status is under immense pressure from federal authorities, that friction systematically trickles down to us, the consumers. You end up dealing with way more false positives and sudden account reviews simply because the bank literally cannot afford to make a mistake.
Okay, let's pivot to Section 3, real estate transparency.
This tightening isn't just happening in your checking account either. The FinCEN real estate rule is massively expanding reporting visibility for residential properties purchased via LLCs and trusts. Now actually, let me clarify that. This rule isn't meant to stop your investments or discourage real estate ventures at all. The primary goal is to definitively trace exactly who the true owners are behind these non-finance corporate transactions to combat money laundering. Total anonymity in these corporate structures? Yeah, that's being completely phased out.
Next up, Section 4, digital trust and limits. Let's look at these updates because they're a pretty big deal. First, the FDIC is mandating clear digital signage by March 1, 2026. Why? Because honestly, over the last few years, the lines between handy little financial apps and actual insured banks have gotten incredibly blurry, and it's causing huge consumer confusion. You need to know for sure if your money is safe. On top of that, the CFPB is expanding disclosures for complex stuff like PACE clean energy loans, which a lot of times get attached to your property taxes. Regulators are essentially forcing mandatory digital disclosures and tighter oversight to ensure you know exactly what you're signing up for. Which brings us to Section 5, the big picture on system visibility. Let's connect the dots here using credit union rates as our final puzzle piece. So, the National Credit Union Administration officially extended the 18% federal rate cap until September 10, 2027, instead of dropping it down to 15%. They also set the payday alternative loan cap at 28%, and they did this specifically to maintain credit access in a high-inflation environment.
Think about it. If they had dropped that rate to 15%, higher-risk borrowers would have been completely shut out, literally locked out of the system.
So here is the hidden blueprint in all its glory. More visibility, more monitoring, more documentation, more compliance, and massive automation. We are looking at a highly coordinated cycle of tightening. In this new era, clean, predictable behavior is rewarded with totally frictionless banking. But messy, high-volume, unpredictable behavior, that is going to create instant systemic friction.
All right, wrapping things up with Section 6, the action plan.
Now that we actually understand this new algorithmic reality, here is your 7-step survival guide. Number 1, strictly separate your business and personal banking. 2, keep meticulous documentation for any large deposits. 3, pre-notify your banks before those large deposits hit so you don't shock the algorithm. 4, ensure your entity ownership docs, like for your LLCs, are 100% accurate. 5, turn on real-time transaction alerts so you're always in the loop. 6, compare those credit union rates really carefully when borrowing. And 7, avoid unnecessary cash deposits that might trigger automatic flags. Basically, follow these steps and you keep your financial behavior clean, organized, and frictionless.
If you take nothing else away from this explainer, I want you to remember this quote directly from our source material. The financial system didn't collapse, it recalibrated. I really want to reassure you that there is absolutely no need to panic here. This is purely about awareness. When you understand the direction of this massive recalibration, you can move smarter, act strategically, and stay way ahead of the curve.
So, I'm going to leave you with this final, somewhat provocative thought. Take a hard look at how you operate day to day and ask yourself, are your finances predictable enough for the new algorithms? I highly encourage you to analyze your own financial footprint right now, well before the March 2026 tightening takes full effect. Get your systems organized, stay proactive, and you'll navigate these changes without breaking a sweat. Keep learning, and I'll see you in the next explainer.